So our second speaker today is Silva Gaku. Silva is a farm financial management outreach specialist at UW-Madison Division of Extension. His role focuses on financial risk management outreach and education. And prior to joining Extension here in Wisconsin, which just happened in December of 2024, Silva served as a research assistant at Kansas State University, where he conducted research on farm debt and combination strategies for farm safety and safety net programs. His extension publications explored how farm policy, crop insurance, and weather-related disruptions affect producers' income, well-being, and financial stability. He has developed interactive maps to inform farmers on insurance policies and payouts that protect against income losses. And just as Leonard was talking about the extension of the Farm Bill programs, again, I'm anticipating Silva is going to talk to us quite a bit about ARC and PLC. So with that, I see Silva is up. I'm going to yield the screen to Silva, and its next half hour is yours. Thank you.
Yeah, thank you very much, Matt. I'm really excited to come share these updates on ARC and PLC. And I'm particularly excited because this is my first webinar here in this role. Today, I would be taking you to ARC and PLC. ARC meaning agricultural risk coverage, and PLC price loss coverage, how specifically they work. I'll then turn to historical payouts for these two programs. I would add some sign-up updates and recommendations for this particular year. Price loss coverage and PLC in short sets a price floor for program commodities. This is done by using marketing year average price and the national loan rate. And for the marketing year average price period, that would depend on the commodity in question. The Farm Bill, specifically the 2018 Farm Bill, establishes the effective reference prices for the program commodities, and these are likely to change over the years. This year, corn commands $4.26, soybeans $9.66, wheat $5.56, oats $2.76. I know the question would be, how would this trigger payouts for producers that sign up their base acres for this particular program? This occurs when prices go below the effective reference prices. A typical producer would then receive 85% of their base acres and payment yield multiplied by the payout rate. Let's look at an example. Looking at wheat, for instance, in 2020, the effective reference price was $5.50. The effective price that takes into consideration the marketing year average price and the national loan rate is $5.05. So the difference between the effective reference price and effective price is 45 cents per bushel. So a typical producer with 105 wheat-based acres and a payment yield of 100 bushels per acre would be going home with about $4,016.25. In the same year, producers of corn who signed up their base acres for PLC did not receive any payout. This is because the marketing year average price of $4.53 was way above the effective reference price of $3.70. I know you are itching to see, so how did this program perform over the years? And to be able to do that, we have an app. We have developed an app to help you in undertaking that particular analysis. So here you would have in your chat the link to this particular app. And I want us to do a quick exercise. What you are to do over here is to first go out there and select a county. The counties here in Wisconsin. And after selecting them, you can go ahead and choose the program commodity and observe the payout under the 2018 Farm Bill. So if I go for corn, I see that payouts were triggered once in the 5-year period, specifically in 2019, and producers received about $13.08 per acre for enrolling in this particular program. I must indicate that we do not account for inflation, the base acres, and the 15% discount that the formula takes into consideration. Well, looking at this, I would be more focused on the county in which we are right now, Manitoba. So looking at corn, for instance, we see that it was triggered, or payout for PLC was triggered in 2019. And producers who signed up for that received $17.56. The remaining years did not trigger payout for producers who signed up their base acres for that. Moving on to wheat, in the same county, we see that payouts were triggered in 2 years, specifically 2019 and 2020. And total payout for the period sum up is $78.24. We will now look at soybeans. Soybeans did not trigger any payout for producers who signed up for PLC for the period 2019 through to 2023. This is because the effective price was relatively higher than effective reference price during this 5-year period. Another commodity of interest is oats. And looking at the period under consideration, we also see that no payouts were triggered from 2019 to 2023. That said, I'm sure you may have done your own comparison, and you could post whatever you have found in the chat for us to see that you are really participating and using this app. Moving on, we'll look at agriculture risk coverage, specifically ARC, or in short ARC. Today, I will be focusing on county ARC because the enrollment in individual ARC is relatively low. Even at the national level, it is around 1%. County ARC sets a minimum revenue for program commodities, and this is done by using Olympic average prices and yields. For the Olympic average prices, I'm talking about them using 5 years preceding the prior year of the program year. And this specifically takes out the highest yield or price and the lowest yield or price. Payouts are triggered when county revenue or actual county revenue falls below the county guarantee revenue. And the guarantee revenue is computed by multiplying 86% by benchmark revenue, which takes into consideration the Olympic average price and yield. So for a producer that elects ARC and payouts are triggered, he or she will take home 85% of base acres multiplied by the payout rate. And I must add that for the various counties, there are yield designations, and these designations are either irrigated, non-irrigated, or all. Let's look at an example. An example here in Manitowoc is that we see that for wheat in 2023, guarantee revenue was $308.30, actual revenue $552.76, and payout rate was zero because actual revenue was greater than the guarantee revenue. The same thing is for corn as well. So no payouts were triggered for corn and wheat in 2023 in Manitowoc County. We also have an app that will help you in doing this. So the link that is shared with you, you are able to go into the app, you are able to select the county of interest to you and the program commodity that you want to look at. And if it says no data available, it means you just have to change the yield designation to some other thing I need to provide you. If the chart is empty like this, it means that no payouts were triggered in this particular period or under the 2018 Farm Bill. Focusing on the Manitowoc County once again, County Act payout for corn were triggered once within this period, and that was in 2019. And the total was $24.38 per acre. Looking at wheat in the same county, payouts were triggered twice, 2019 and 2020, and giving us a total payout of $81.60 per acre. For soybeans, we have payouts triggered once in 2019, and payout was $46.18. Oats, also, we see that it was triggered once and less than $1 per acre was issued. Now let's come back to how to sign up for these programs. One approach is to go to your local FSA office, and the link is provided for you. So all you have to do is to select the state in which we are and then your county. And once you are done, you should be able to tell the office closest to you. You can either place a call to Vicky, Joe, or Eric about this. You can also sign up for these commodities for these programs by using the online tools provided. And that you just have to log in and elect your choice or make your choice. You are allowed to make this election all the way till April 15th. So please take note of that. What we encourage is that you can go ahead, make your elections today, and make updates or changes in the future if possible. Producers should also be made aware that they can also combine County Act and PLC for different commodities. So if you are a producer of wheat and soybeans, you can sign up for County Act for your wheat, and for soybeans, you can elect PLC. And when payouts are triggered, we should expect payments by October 2026. Moving on, let's look at some recommendations, and I would want to draw your attention to the prices. We have here on your screen prices that would trigger PLC payout and prices that would trigger County Act payout. What does this mean? The Act trigger price. This tells us that when county yield is close to the benchmark yield, we are expecting that when prices go below these prices, county ARC would trigger payout for the particular county. And taking a ratio of the ARC trigger prices to the PLC trigger price, we see here very well that PLC is less likely to trigger payout compared to ARC. Or to make it much differently, or to put it quite differently, look at this chart. The red one is for ARC, the blue is for PLC. When the point is above 100, the mark over here, the line over here, is telling you that the program is likely to trigger payout for that particular commodity. So when you look at corn, it tells us that both PLC and ARC are likely to trigger payout. And for soybeans, we see that PLC is less likely to trigger payout, while ARC, or county ARC to be specific, is likely to trigger payout, considering the market dynamics we are looking at. For wheat, the two programs are less likely to trigger payout. But you can bear with me that the arc point, or the red triangle for wheat, is very close to the 100 benchmark that we looked at. So with this, when yield losses occur, we expect that county arc would trigger for wheat. For oats, we expect that county arc will be more likely to trigger payout, while PLC is less likely to do same. We have a payout likelihood table here, and here you see that corn is likely to trigger payout for the two programs, and for the remaining three commodities we considered over here, they are less likely to trigger payout for PLC, or PLC is likely to trigger payout, but then ARC is more likely to trigger payout for producers who elect their base acres, or who elect or choose those ones. What are then our recommendations? For wheat and corn, you should go ahead and choose county ARC. You would be puzzled by the fact that we should go for county ARC for corn, because these two programs trigger payout, or are likely to trigger payout. We are going for county ARC because the payout for county ARC is likely to be more than that of PLC. Moving on, for oats and soybeans, producers can go for county ARC as well, because the county ARC program is more likely to offer payment. But if you are a producer and you are interested in signing up for the supplemental coverage option, SCO, you are kind of restricted. You are to go for PLC. Based on this, the historical payout that we have observed, we see that some commodities receive little or zero payout over the 5-year period we considered. And this is largely due to the high prices and demand for these commodities. In 2025, we expect that payout or ARC payout will be more than PLC payout for corn, so producers can choose county ARC. And for the other recommendations, producers can go out for county ARC and make revisions if there are any in the future. So for questions, you are more than welcome to reach out to me on this number and also my email. And I am quite aware that there are some of you who might be interested in commodities like barley, sorghum, and sunflower seed. Those we have also done the analysis for them, and we see that one barley, you should go for ARC, but then do not expect payout. For sorghum, yes, these two programs are likely to trigger payout in this year, but then ARC is expected to pay a lot more. And for sunflower seed, the two programs are likely to trigger payout. And on that note, I would draw the curtains, but then I would want to throw your attention to a different program here, economic assistance, that was passed quite recently in December. And we have done some calculations for what producers are likely to receive for their program commodities or commodities covered. You can take a look at it. The link is provided for you so that you can take a look at them. Thank you all so much for participating.
Silva, so you said they have a deadline by April 15th.
Yes.
And then I think when we actually get a new farm bill in the past, when you go to your FSA office and sign up, you're signing typically for the entirety of
Hello?
the
I
FSA
can't hear
period.
you.
You can't hear
Hello,
me.
Matt.
Hello. Now? Can you
I
hear me
could
now?
I could hear both of you.
Okay, I can hear you now.
Okay. So my question was, this year we're only signing up for 1 year, this choice of ARC and PLC, right?
Yes.
But normally, when there's a new farm bill, you're signing up for the entirety of the farm bill.
Yes, so what we saw under the 2014 Farm Bill was that producers sign up for 5 years or so for the 5 years. But then under the new Farm Bill, which was the 2018 one, in the first 2 years, 2019 and 20, producers made one sign up. And then after that, every year they were to sign up or make elections. So under the 2018 Farm Bill, I would say they were annually made to sign up for these programs.
Okay. And then it does get to be fairly complicated because I think you felt that for the entire state of Wisconsin, you got current recommendations, but it is a county-based result. So there could be times when it makes more sense in a certain commodity in a certain county to go one way than other. You're giving advice for the whole state that can be changing, correct?
Yeah, so based on the data that we have, that's when we are making those recommendations for the whole state here. So like we said, some counties, there is a possibility that the other program may do a lot better. But then when you look at price loss coverage, it's a national program. It doesn't, let's say, take into consideration the county.
Okay.
So, because it is for price protection. So if that is triggered at the national level, then every other person takes it. But if it is not going to be triggered, then it means that no matter which county you are, you don't get to receive payout. So that is why we are shooting more for ARC County or County ARC, because it offers protection on both sides, from the yield side and also from the price side as well.
And there's it's not like where Leonard's talking to us, and it's not producer funded, these programs. It's you should participate. Your question is which one is more likely to have a payout, or really that's your choice. There's no investment from the producer in either of these programs.
No, there is no investment. They are free. These two programs are free to enroll in.
Yeah.
All you have to do is to maybe go online and sign up, or go to your local FSA office to sign up.
So I am looking, I don't see other questions for you. Just point out to people that we have shared a number of links, but I do know Leonard was wanting to give us a little bit more comment on base adjustment. I think that's what you wanted to talk about, Leonard.
Well, I just get a lot of questions on
production history, right? And then also, how the USDA has set their tiers of production. First tier is 5 million pounds. Second tier is everything above that. And I'll frequently get asked like, hey, when are we going to be able to adjust this? Because if you look at 5 million pounds, we're at approximately, let's call it a 250, 300 cow operation, something like this, right? Depending on how you want to do the math. But, I think at the end of the day, when we take a look at, what it would take to increase tier one, as far as the amount of pounds that are covered, or any changes to premium rates or any changes really to the program at all, it all comes down to appropriations. So I think at the moment, it seems like, unless policymakers decide to allocate more funds to the program, I think that's what it's really going to take in order to change any of these, coverage levels, looking at, changing the amount of pounds per tier, all of these things. So, I think that's the political discussion or political debate, around this risk management program that has to take place if we're going to see any changes to kind of where these levels are set.
I've listened to ag economists many times on these programs, and they've discussed that this is not supposed to be a profit maximizing program. It's supposed to be a risk management tool. And you were showing this forecast that is not highly probable for payment this year, but you alluded to it. I suppose it always seems like an uncertain environment, but I think somewhere greater than 15% of our milk is normally getting exported these days. And these trade wars and tariffs and counter tariffs, seems to me there's a pretty high level of uncertainty on that end. And certainly like, well, 15%, but if you lose a market for your entire 15%, that really backs up all the domestic demand as well. So there's that uncertainty, but we do by March 31st, we're kind of know you're enrolling for a program already knowing what has happened for a quarter of the year, basically, correct?
Correct. Yep.
Yeah. All right. So I don't see other questions here. So there was a poll. Hopefully everyone had a chance to reply to the poll. And we're right up against the end of our program. So I'd like to thank both Silva and Leonard and the rest of the team here who's made this possible. Hopefully you've got some valuable information about important programs, both for dairy farmers and crop producers, as far as risk management associated with the Farm Bill extension for 2025. So thank you. This is Matt Lippert, UW-Madison Division of Extension. And hopefully you can join us again in future webinars as we make them available.